All right, in this last session for this class, I want to get into this concept of portfolio management. Remember, question one on exam, we asked what is a portfolio? So it's a collection of assets held for some future purpose, like retirement. So here we talk about managing a portfolio. We have all the tools we need from exam one to be able to do this, but you want to actually construct your portfolio. And I've talked about this in class. Strongly recommend that, especially if you're a finance major, but even if not, that you get an account at some place like Ameritrade or Robinhood or someplace and set up an account. I know Ameritrade will let you do paper trading, so you can set up an account, fictitious money, and just build a portfolio and just start experimenting, buying stuff. If you don't have actual money to invest, then at least go out there and use play money to get into the habit of making an order, thinking about limit orders and market orders and stop losses. Uh, think about options and futures that we'll talk about here a little bit later. Just give yourself a chance to actually experiment with what it means to be an investor. That way, if you have a brokerage account later, or if you're working for a firm that works with individual clients, you want to make sure that you've done those trades before you're on a sales floor or somewhere where you're actually helping people with this kind of trades. It just helps, definitely will help you in your interviews. So let's walk through this. So if you wanted to start an actual portfolio, well, first of all, essentially you need zero for a paper portfolio. So that's real important. So there's nothing, if you don't have money, there's nothing to stop you from trading. So if you think, let's try Ameritrade. So if you go to Ameritrade, here's their official site, but you can actually do www.thinkorswim.com, thinkorswim.com, and they have a open new account. You can go in there. They actually have trading tools that you can try. It's similar to what we do with the investment society with our student run stock portfolio. It'll look a little bit different, but it's the kind of thing where you can put information in and say, I want stocks with low price to earnings ratios. So you're looking for value stocks. Or I want stocks whose return on equity has been at least 20% the last 3 years. So you want firms that are growth stocks that have strong, solid earnings. I want stocks whose debt to equity is lower than 50%. You want to make sure you have high quality stocks. However you want to screen it, find some stocks, throw some money in there. You can do technical analysis if you want to, relative value analysis, fundamental analysis. So if you open it, I don't want to do open new account because I don't have an account with them. But if you do, you can certainly go through all the process, open the account. I've not used Ameritrade because when I worked at USAA, we had a trade desk, so I just got used to using a trade desk, and then I used USAA's brokerage, which will now be Schwab, so I guess I'll be a Schwab customer. But so find a broker, set up a broker. There's plenty of them out there. Schwab, Ameritrade, Robinhood are the most popular ones, but most firms like Fidelity, Vanguard, USAA, used to be USAA, but most investment firms, BlackRock, if you go to their site, many of them will have a brokerage service. A lot of them, it's just the cost of doing business because brokerage doesn't usually make much money, especially now that Schwab and Ameritrade are doing free trades. It's a very, very difficult business to make money in. They make most of their money off of their margin accounts. And so, it's just becoming cutthroat business. These are businesses that used to charge $50 per trade, and now they're charging zero. So there's really no argument not to get an account now. It's not that expensive. If you want to trade stocks, if you're using an actual portfolio with money in it, you will have to have probably at least $100,000. If you want to do mutual funds or exchange traded funds, you can definitely get by with just $5,000 or $10,000 because there you're buying multiple stocks at the same time. But just think, if you only have a $10,000 portfolio and you want Google to be one of your stocks, one share of Google is over $1,000. So right there, you already have over 10% of your portfolio all in one stock. So it's hard to diversify with a $10,000 portfolio. But ETFs are fun. There's a lot of them. We talked about those earlier in class. And boy, you can, if you have $10,000, you can do a lot with ETFs and get pretty exciting strategies, and definitely get your money in. You know, if an ETF might have 1,000 stocks in it, but it's trading for $150, then $10,000 you can buy plenty of shares of that ETF. Be well diversified. On the bond side, it's much more difficult. It's very, very hard to buy individual bonds. And people who do it, small investors that do it, usually get ripped off pretty badly. It's hard to buy a corporate bond. You can buy Treasuries. Treasuries is not a big deal. If you go to Treasury Direct, I think treasurydirect.gov, you can buy Treasuries online. I've done that. It's not very difficult to do. You don't have to have that much money to do it. Sorry, I should turn off my Facebook. So it's not that difficult to do. But if you're doing corporate bonds, you're probably going to need to trade in $50 million blocks, which means one bond would be 50 million bucks. So to be diversified, you probably need several $100 million. You could probably get by with a $100 million portfolio, but these are over-the-counter types of markets. You need a good broker. You need a good trade desk. You want to make sure you're not getting ripped off. I remember at USAA with municipals, USAA is a big municipal buyer. Municipal bonds, if you remember those, are tax-free. A lot of individual investors will buy individual municipal bonds, but boy, USAA would watch some of these trades and just watch how small retail investors are getting ripped off, losing 8 to 9% at the point of the trade. A bond they should be buying from 92, they're getting sold to them at 100, so they're losing a lot in the very first trade. So it's very dangerous. Now, bond mutual funds and bond ETFs, there are bond ETFs now. You can definitely do that. What about alternatives? We talk about gold and commodities. Well, again, exchange traded funds open up a lot of opportunities there. You can also do a lot of those things by using the futures market, and we'll talk about futures later. So if you do futures, if you go onto Ameritrade, even with a paper portfolio, they'll let you do futures and experiment. So you can definitely get into a lot of these asset classes outside of just ETFs. But ETFs is probably the most logical thing for a small investor starting up to do, because you get so much more diversification very quickly. So when you're picking a stock, there's two questions you have to ask. What is a good company and what is a good stock? So good company can be fundamentals, good ratios. You should have studied that in 3013. Return on equity, margins, turnover, your capital ratio, your working capital ratios, those type of things. You can look at risk versus quality. So you look at how much debt they have, what is their beta, how stable their earnings, how high quality is management. Quality of management is a great thing to desire, but how do you screen on that? How do you find companies with good management and companies with bad management without just going, and talking, listening to the conference calls? And I have made some investment decisions based solely on listening to the presentation from management to their stockholders and thinking, wow, I don't think this person has a good strategy, or I think this person's really brilliant. But it's hard to do that with 3,000 companies. So, but a lot of this stuff you can do in a computer. Mathematically, they're easy to bring in. If you haven't been part of Investment Society and you want to learn how to do this, then join. We have classes in the fall. Hopefully we'll be back on campus in the fall, and you can have classes and we'll show you how to do an entire portfolio from scratch. And then you want to ask, what is a good stock? So here you're looking at valuation. So you may have a great company. I think Alphabet, Amazon, Apple, these are all great companies, but the question is their stock overpriced or underpriced? And that's the things you're doing on papers 3 and 4, where you're coming up with the discount rate and doing discounted cash flow analysis, or it's the relative value analysis that we did. So both these companies have to be asked. So both of these questions have to be asked. So it's possible you have a good company that's a bad stock because it's too expensive. You could actually have a bad company that's a good stock because it's a bad company, but it's so cheap. And maybe it's a bad company because it has bad management. Well, that would be a great company to buy, because bad management keeps the stock cheap. You buy the stock cheap, and since everybody knows the management is bad, they'll get fired. New management will come in, they'll fix the company, and you bought the stock cheap and now you see your stocks soar. These exact same questions go with bonds as well, except for with bonds, you're not looking so much at valuation as you are at spreads. How much spread am I getting on this bond? Am I getting 15 basis points, 60 basis points, 80 basis points? Is that enough versus what other bonds of comparable risk are giving me? Right, so if you're going to build a portfolio, let's go through the process. And then next class, I'll show you the efficient frontier. I don't think I'll get through it in this class. But the components of a good building a portfolio has a philosophy, a process, the actual execution, construction, and then risk management. So if you're interviewing, you remember I talked about exam question 1 is a great thing to bring up in an interview. Here's another thing that looks really good for an interview process, that you go through this process yourself in building a portfolio, and then you bring it up into an interview question. They might ask you, why do you think we should hire you here? You can say, wow, I love this stuff. I have my own portfolio. I've built my philosophy, and I have this process, and this is how I do portfolio construction, and here's my risk management and sell discipline. That sounds impressive for undergraduate students. So if you haven't done that, you want to do it. So what is a philosophy? So a philosophy are statements that start with the words, I believe. I believe stocks with these characteristics will beat the market. And you've got to come up with for yourself. And if you don't have one, let's say, wow, I'm just starting out, I don't really know what I'm doing, then go out and find some of the blogs and some of the web pages of people who've been doing this for years. There's plenty of people out there, and just copy them. Do what they're doing. Cliff Asness is one of my favorites. He has a lot of YouTubes and articles. There's others where I could give you all kinds of names of people that you can go listen to and come up with your own philosophy. There's a book I really like by William Priest. It's called Shareholder Yield. And in there, he gives a philosophy on investing, where he wants to invest in firms that produce strong free cash flows, and he talks about what that means. And most of the book, you think I can do this myself. His appendix at the end is very complicated, so you might get a little scared when you read the appendix. I find it a little bit mathematical, but most of the book, you think, wow, I can do this. I could calculate these numbers. So your philosophy is it could be based on fundamentals. Very similar to what we talked up here, a good company, fundamentals. You want firms that are high quality, at a reasonable price. You may want firms that are growing fast. You want firms that are stable. You want firms with high quality management. Again, how do you screen on that? How do you find that? Quality, you might look at their credit ratings. Let me show you something that Cliff Asness said. I love this theory. So small cap value has been the winning asset class historically. And that means high returns with only slightly higher risk. So it's like you're taking on a little more risk, but boy, you're really getting paid for it. But recently, this has gone away. And what Cliff Asness says is, okay, it's true, small cap value doesn't look as good as it has in the past, but if you get rid of the junk, what he calls junk, it still works very, very well. So what does that mean? So here's a very simple process. This could be your philosophy. This is something you could bring up in an interview, and you could just listen to what Cliff Asness says, and it's just say, okay, I'm going to take the Russell 2000 stock index. So the Russell 2000 stock index, that's US small cap. And I'm going to do the Russell 2000 stock, and I'm going to put the word value. So I want small cap, US small cap value stocks. And then I'm going to sort them by quality. Now, how do you do that? Well, Bloomberg has a probability of default ratio. So you could sort them by the Bloomberg's probability of default. And you could kick out the bottom 1,000 and keep the top 1,000, or probably would be best is take the 10 highest quality of each sector, something like that, because there's 11, 12 sectors, then that's 120 stocks. Then go in and buy, or maybe do 100 stocks, and go out and buy a few stocks in each sector so you're well diversified. You might look at the size of each sector so you don't overweight, materials or underweight technology. You probably need to have about 20, 25% in technology, but just sort it by Bloomberg's probability, and then you've got, then you've got, high quality stocks. You can't buy 2,000 stocks. You can't even buy 1,000 stocks. The Russell 2000 Value Index has about 1,000 stocks in it because it's just a Russell 3000 split evenly between growth stocks and value stocks. But if you did that, you'd have an asset class that has done extremely well historically, but has been drugged down. Remember when we talked about value stocks, these tend to be lower quality companies. So if you kick out the lowest quality ones, what you have are some decent quality companies that are cheap. You want to have diversification, so you buy the 10 highest quality in each sector. Now, I'm not saying you should do this, but right there you've got a strategy you could talk about in an interview, and you could actually set it up in Bloomberg and test it, something I've been thinking about doing myself, and just seeing how it would have done over time. It'd be interesting to set up. But that's what we mean by philosophy. I want small cap value. They've outperformed, but I'm worried about the low quality of small cap value. So I want value, but I want high quality value. Is there such a thing? Well, yeah, you can create it yourself. Valuation is another one. You just say, I want low PE stocks. Now you got to be careful. That is essentially the same thing as value stocks. So I think you just got to be careful when you say, I want cheap stocks. Most cheap stocks are cheap for a good reason. You might want to look at technicals, price trends. The most popular one, again, Cliff Hassness will tell you all about this. Momentum works very, very well. Stocks that have been up recently continue to go up until they don't. And so just by buying stocks that have been going up recently, actually gives you good momentum, and you just ride that wave. It's an incredibly powerful strategy. And Cliff Hassness and others, GMO, if you go to gmo.com, they are very big in momentum. In fact, their philosophy is high quality stocks with good momentums beat the market, and that's there. You'll find some thematic investors. They could be top-down econometric types of analysis, or they could be stock pickers, but they have some theme. Their theme might be the baby boomers retiring. It could be the growth of China, or it could be the growth of India, or anything that says these are the themes that we think can work well going forward. I gave you an example of the writer who wrote Street Smart, and I can't never remember his name, but he said Asia's where the growth is going to be this next century. So I want companies that are providing services or products to Asia. So that could be a theme. You might have a theme about artificial intelligence. So I know in Investment Society, Miguel gives our market outlook, and he's a big believer in artificial intelligence, machine learning, 5G technology. So that might be your theme. But you have some theme that you think is going to be the place to be where the growth is. If you can backtest, that's great. Backtesting is extremely difficult to do because one of the biggest issues with backtesting is survivorship bias. When you test a strategy and you go back historically, the only stocks you can put into your strategy are those that didn't go out of business. Because if a stock goes out of business, it's no longer usually in the database. There is one database out there that actually still includes stocks that went out of business and just have some go down to zero. But most databases, like Bloomberg, the Bloomberg machine, the only stocks there are the ones that are still in business. So that means you're already starting off with a positive bias, because firms that have gone under are not there. So obviously your strategy is going to be good because you avoided firms that went insolvent. But would your strategy have really avoided those firms that went insolvent? Or are you just backtesting it and you're avoiding them simply because they're not in the database? So that's survivorship bias. You could Google that term and learn some more about that. So I'd recommend Google survivor bias and go to Wikipedia. Let's see if it works. Survivorship bias wiki. See if something comes up. There it is. Survivorship bias. I don't know if this is going to be a stock question. Looks like it is. Concentrating on people or things that made it in the past selection process and overlooking those that did not. Yeah, it goes beyond just investing. You've seen books where they say that the tactics of the most successful CEOs. And so they go look at all the successful CEOs and say, here's the 5 things that they do. Or there's a book out there, The 7 Habits of Highly Effective People. What they fail to do in those books is notice that those 5 habits of CEOs that do well were also the exact same habits of the 500 CEOs that went out of business, that lost their jobs and failed. So there's that survivorship bias. You're looking at the successful ones because they're there. You don't realize the unsuccessful ones did exactly the same thing. So it's a good term to look up and have some background on. All right, so what we'll do, I'm going to finish this process up next time, next class. And then what I'll do next class is I'm going to show you how to construct an efficient frontier in Excel, and then I'll show you an actual efficient frontier I use in my risk management class.